Hi and welcome back to another video with me, Becky and Siren Crypto. In this video we're going to explore the meaning of the term leverage and what it means for us as traders or investors, the good points and of course the bad points too. This is part of our series of bursting through the jargon in the markets, and I thought a good one to do this time around is this idea of leverage. Firstly, here's our disclaimer. This tutorial is for educational and illustrative purposes only. We are not responsible for any investments made applying this information or buying or selling recommendations. Siren Crypto are not licensed investment advisors. We make no recommendations to purchase or sell any kind of coin, option or security. Any investment contains risk and is 100% the responsibility of the investor to assess the risks and rewards involved. Trading the crypto market involves a high degree of risk, and you may incur financial losses if you engage in this activity. We at Siren Crypto take no liability, assumed or implied, from your application of the information we share within our training programs. Now, if we're trading, we can often use leverage on certain exchanges, but I think it's really misunderstood. And how does it work, and what are the risks and what are the potential rewards? It's something we do use in our everyday life. So let's just start off right with the basics. What is this idea of leverage and how do we actually use it in everyday products, not just financial markets? So let's look at some everyday uses for leverage where it's pretty common. The most obvious one is houses. There are not many of us who will go out and pay cash when we're buying a house. So there's an element of leverage involved. Let's say we're buying somewhere for 200,000. Our deposit might be 20,000, but we end up borrowing 180,000. So that's one example of leverage in everyday life. Another purchase, normally the second biggest one after a house, is a car. And again, there are not many people who will go out and spend, let's say, 30,000 cash on a new BMW. So they will go out, put a deposit down and borrow the rest. Again, they are leveraging to get an asset. In this case, what is probably going to be a depreciating asset, but they are borrowing the money. Let's bring this a little bit closer back to home and back to the world of markets. Let's say you were convinced that a certain share was going to go up in price and you wanted to have as much exposure as possible to that share. You might decide that over the next 12 months that the share is going to go up 20% and you decide to borrow 10,000 to invest in that share. It costs you 5% a year, but you're confident that you think you can beat the cost of the financing, in this example, by the growth of the share price. In reality, it's much easier than going out and getting a loan, but we'll talk about that more when it comes to margin trading. But that's just an example of leverage in the investment world. The really basic principle of leverage is using a small sum of money and effectively borrowing more money, so magnifying the size of the money you have to get bigger exposure, to whether it's a car, a house or an individual share or a trading pair. Clearly, there are risks and rewards when this comes to investing or trading. So let's just start to spell those out before we go any further. With all decisions, there are good points and bad points, and there are clearly pros and cons when it comes to using leverage in investing or trading. So let's have a look at the plus points first of all. Let's just head back to the example where we borrowed our mythical 10,000 at 5% a year to gain exposure to a share. The plus point is, let's say we are right and the share price goes up 20% over the year, we've made 20% on our 10,000. We've made a profit of 2,000 in that particular example, but it's only costing us 500 in interest. So the clear benefit is that we can get a bigger exposure. So if we are correct, we make more money than if we were not using leverage. So if we had only put in, let's say, 1,000 of our own savings and it goes up 20%, we have only made 200. Leverage, when we are right, gives us more bang for our buck, but there's no such thing as free money. It's never just a one-way bet when it comes to investing in financial markets. On the flip side, let's say the share had dropped 20% over the year and our decision was wrong. We have borrowed that money, that was 10,000, and now it's only worth 8,000, so we've lost 20%. On top of that, we're paying this 5% charge. For leverage, the obvious plus point is that it magnifies our profits, but of course, if we're magnifying our profits, then we're doing the same to our losses. So increased exposure means that we're going to end up with potentially facing bigger losses if our decision turns out to be wrong. This is true also for investing and trading when we're using leverage. In our next video, we're going to explore this idea of leverage and when it comes to trading. We will look at how it works for margin trading and look at some real examples. But just to give you a flavour of what we're going to talk about, let's look at some typical leverage multipliers for a couple of popular markets. And once again, let's look at the pros and cons. On certain exchanges, there is the opportunity to apply leverage. It's not unusual to have exchanges offering 100 times leverage. Let's say we have 100 times leverage if we did a trade, say, on Bitcoin. Our total exposure was 10,000 in this example, and we would only need to deposit or tie up 1% of that. Therefore, we would have a position where we have 10,000 exposure, but we only have 100 initial deposit. That's leverage. On some exchanges, the leverage isn't quite as big as that. We may get 20 times leverage. If we did a trade that, let's say, has a total of $1,000 or so position, we would only need to tie up 1/20th of that, in this example, so 5%. We might have a situation where we only have $50 initial deposit tied up, but we still have that exposure of over $1,000 overall. So we're controlling a $1,000 position, but we only initially have tied up $50 on our account. There's a couple of examples of how leverage works when it comes to trading, but don't forget it does cut both ways. We do have the exposures for a relatively small initial deposit. It's going to magnify our profits, but also magnify our losses if the trade turns out to be wrong. Well, that's our introduction to leverage. Used sensibly, it can be a very powerful tool for individual investors and traders. It can help us increase our exposure and potentially deliver more profits. But of course, hand in hand with that goes the risk of bigger losses than if we weren't using leverage. We're going to explore this in more depth when we talk about margin trading and how we can put steps in place to limit those losses. Well, let's wrap this video up here, and if you like this video, give us a thumbs up. Make sure you don't miss out on all of our videos by clicking the subscribe button. You'll get notified when our next lesson is uploaded. Well, I'm Becky. Thanks for watching Siren Crypto, and I'll see you on the next video. Happy trading.